I hope you can all hear me. Good morning, everyone. I'm very pleased to see so many of you here in the audience, and also those who are participating virtually. We just heard from Finance Minister Liu Kun and Governor Kuroda about the multiple shocks that hit the region and the challenges facing the region going ahead. And Governor Kuroda in particular stressed the need for regional cooperation. CMIM is a good example to meet those challenges. So never has the region been struck by so many shocks, one after another. No sooner had the region emerged from the COVID pandemic shock than the war in Ukraine broke out. And because of that, there was a surge in oil prices, food prices, supply disruption, and this in turn led to higher inflation across the world. And because of that, it forced the Fed to reassess its monetary policy stance and to start tightening policy more aggressively. So we got hit by high interest rate, high inflation, and this led to capital outflow from emerging markets. It caused a currency depreciation, and it forced many of the central banks to tighten policy, at a time when they are just emerging from the pandemic. So to help us understand, the situation and the policy responses, we have assembled a panel of panelists here, a very distinguished group from IMF, ADB, BIS, as well as the policymakers from both the Ministry of Finance and the central banks. So I guess the key question is, how resilient is the region? Will the shocks and challenges derail the recovery again? Because it was derailed in last year with the upsurge of the Delta variant. And this year, the Omicron struck, and we were hoping that, actually worried that it might derail the recovery, but as it turns out, the Omicron turns out to be quite mild, and most of the countries continue to open up. Will it lead to another financial crisis? This is another question that many people have. Or financial distress, maybe in the household or corporate sector. And how should policymakers respond to these challenges and shocks? What measures or actions should they take to mitigate the risk? Are they behind the curve? Should they have done things differently? Do they still have sufficient policy space? And this is important because next year is going to be a more difficult year for the region, because I think, as you heard from the IMF MD, they expect growth to slow down quite sharply, and there's a downside risk. Or should they resort to unorthodox measures in that event to try to address some of these shocks, including maybe capital control? So to help us understand this, we have a group panelists here. I would like to start with Sanjaya Panth. Sanjay is an old friend of mine. We have known each other for some time. He is currently the Deputy Director of the Asian and Pacific Department at the IMF. Sanjay.
Thank you very much, Hori, for that. First, let me begin by congratulating AMRO on this incredible event that you put together. I think this is going to be a very important point in the calendar going forward every year from now on. And I'm very grateful and honored to be here to represent the IMF. So with that, Hoi, you've asked quite a few questions, and I'm not sure I will be able to answer all of them, but let me try to give you a little bit of a flavor on some of them. What I will do today is I will talk a little bit about some of the global challenges, give a little bit more meat to some of the things that we've already heard about. Then I'll focus on the region, and then talk about the policy imperatives, the policy needs going forward. So with that, let me begin on the global challenges. As the MD mentioned, our growth forecast for this year has been, we've successfully revised downwards. It's about 3.2% for the year as a whole, and expected to slow down to 2.7% in 2023. But I think what is also very important to remember is that it comes from 6% in 2021. So the growth slowdown has been quite large in the region. And the other, in the world, this is our global forecast. But one thing you also notice from the chart that you have way on the left-hand side is that this slowdown is pretty global. It's affecting all economies across the world, some more than less, and I'll get into some of the differences with the ASEAN region a little later, but it is pretty universal. The second thing, of course, is the inflation. And the inflation has had a number of factors, but I think Russia's invasion of Ukraine and the very sharp rise in commodity prices has led to an increase in inflation globally. I think Asia started a little bit behind in terms of the pickup in inflation, but it has come in quite clearly now in Asia as well, and has become quite a bit of a challenge in a number of countries. So with that, turning to the next set of issues, with this increase in inflation, we have had global financial tightening. Of course, everybody knows that the Fed has quite increased interest rates quite a bit. We've seen capital outflows, which the middle chart shows, and this is again for emerging markets as a group across the world, not just in Asia. And one thing also to keep in mind is the housing markets. I think this speaks to the financial stability risks, some of which has been raised earlier. I mean, this is a worst case scenario almost, but we do see some risk of a very sharp housing price decline as well going forward. So with that, let me turn to the next set of challenges here. So the big thing here has been the dollar strength. I think most emerging markets in Asia have lost about 10% or so of the value against the dollar before recovering recently. You see that chart on the left. The depreciation is explained in large part by differences in yields, in interest rate differentials between the US and emerging markets, including in Asia. But also I think what's important to note when you look at the left is that despite the tightening that has occurred in Asia over the last, this past year, and so the yields have increased in Asia, it's still not far different now from what the historical average has been for the last few years. So the tightening has not been, has been quite that sharp. And then also, we do have quite a bit of outflows within the Asian region as well, but it's been quite heterogeneous. It's been, limited to a few specific countries more than others, even though when you look at the aggregate, it's broadly in line with what we've seen in previous stress episodes. One thing on this chart I think I'd just like to mention is, on the right-hand side, when we talk the extreme part, we talk about depreciation and how that is fed into different levels of inflation. One thing we've found out is that the pass-through itself changes as the level of inflation increases. So in low inflation periods, the pass-through is much less, but as inflation picks up, the pass-through itself becomes much more going forward. So this is a risk, that we need to keep in mind for countries in the region. Okay. The last, big factor of obviously that we'd like to talk about is that the slowdown in China. Again, this is well known, so I don't need to spend too much time here. Couple of things, clearly the zero COVID policy and the disruptions have played a role, but also the housing market and financial sector related stress on that. One thing is, obviously China is incredibly important in the region in terms of the linkages through both financial as well as real flows. And we've done some studies to see how a slowdown in China would affect the region, the rest of Asia. And you see that way on the right-hand side of the chart. And essentially, it is quite significant, which is not a surprise. But one thing that's also very interesting, at least to us, was that the nature of the shock in China makes a big difference in how it impacts the region. Well, if it's a supply shock in China, it impacts the region in one way, whereas if it's a demand consumption related shock, it impacts in a slightly different way. So in China, we're seeing a mix of both in a sense now. So that's again something to keep in mind. So coming back just to give you a sense of where countries as a whole are in terms of the world and Asia. I think our managing director spoke to this earlier, and this I think chart just emphasizes that point. That I think we have revised the Asia and growth downwards quite a bit, including ASEAN. But Asia is still a very bright spot in the global economy. If you look at where Asia stands with 5% in 2022 and 2023, about 4.7% for ASEAN, and for Asia as a whole, a little lower because we've had larger slowdowns in places like China. But overall, Asia is still a point of resilience in the global economy. That, of course, does not mean that there are challenges going forward, but it is something that I think one does need to keep in mind. So now with that as the background, let me now turn to the policy challenges that we see that all of this lays out. And I'll speak to 4 sets of policy challenges, right? The first one is the interaction between monetary and fiscal policy. Clearly, with inflation on the rise, monetary policy will have to play the first line of defense, and countries in the region are increasing interest rates and tightening, as we've seen. But it's also very important that the 2 levers of policy move in the same direction. You cannot have fiscal and monetary policy working at odds with each other. So the left-hand chart shows you a quadrant of where we see different countries in terms of their relative standing with fiscal versus monetary policy. And most our ASEAN economies, at least, the emerging ASEAN economies, are on the top right-hand corner, where we have begun to see the fiscal tightening as fiscal support for the monetary policy as well. We are in the right place. That is not to say that all of it is sufficient. We may need to do a little bit more going forward, but at least in the direction we're right. But this also speaks to the longer-term challenges, again, on the public debt side. Asia's debt is still quite low, but it has increased like elsewhere in the pandemic, and it's important for fiscal policy to continue to play a role with that as well. Second is the dollar pressure, in terms of challenging the environment. We've seen reserves fall quite a bit, and I think Governor Kuroda spoke about that earlier as well. It's way on the left-hand side. Valuation changes are probably quite a bit behind that, but although we don't, the region is behind the rest of the world in terms of publishing intervention numbers. Most of the world has now published them, but in Asia it's still a little bit behind, so it's very hard to tell. But our best estimates is that there has been quite a bit of intervention as well. So it's not just valuation effects, there has been quite a bit of intervention as well. And again, as I mentioned earlier, the pressures mainly reflect interest rate differentials, so it is fundamentals that is at play here. We have seen some volatility, which the right-hand chart shows, but nothing that's extremely out of the ordinary. So financial markets have continued to function quite well. The foreign exchange markets have continued to work quite smoothly. So that's something to take comfort on in going forward. Just quickly, a couple of more slides, and then one thing is, now moving a little bit beyond the short-term conjuncture, looking ahead and over the long term, we've done some work to figure out how much scarring has occurred as a result of the pandemic. And by scarring, we mean reduction in the growth potential of the economy, right? I mean, with COVID lockdowns, children have not had, the education has deteriorated. There has been, postponement of investment activity. So we did some studies to look at scarring across the world. And although Asia is relatively doing quite well right now, we do find that actually scarring has been more in the Asia-Pacific region than most other parts of the world, which the left-hand chart shows. And then within Asia, the ASEAN region in particular, on the right-hand side. So this calls for the need for continued very strong structural reforms going forward, which also to increase productivity, get back on, digitalization, all of that, but that also requires investment. So that's another reason to focus on fiscal policy. And then finally, on the last slide, fragmentation. Again, this has been a theme with our distinguished speakers earlier. Asia, this region, is the poster child for the benefits of globalization and greater financial and global trade and financial integration. And I think because of that, it also is the one that's likely to lose the most if fragmentation continues. So this is very much a concern on our minds. Now, fragmentation can play out in 2 ways, right? One is the actual fragmentation itself, which of course will lead to trade divergence and reduction in trade, but also just the risk. It creates uncertainty. Even if fragmentation is not imminent, the fact that it may happen causes uncertainty, and what uncertainty makes people postpone investment, and that drags down growth. And we're already beginning to see some of these risks play out in the region. So this is something that it's very much already here and mindful, and this is another plea for global cooperation and regional cooperation. I'll stop at that. Thank you.
Thank you, Sanjay. So that was a very comprehensive overview of the global and regional outlook and the policy responses by the region. I'm glad to hear that the region was responding pro-cyclically to the shocks, although I'm a big surprise at the scarring effect. Next, I would like to invite Cyn-Young Park, another old friend. Cyn-Young is Director of the Economic Research and Economic Cooperation Department at the ADB.
Okay. Thank you, Hoi. And also, I would like to take this opportunity to thank Director Lee and AMRO colleagues for organizing this timely event and inviting me to share some of the thoughts. I'm glad that Sanjaya actually spoke before me because I don't have to repeat a lot of the macro context. But I want to focus a bit of structural weaknesses of the global financial systems and especially the FX market and what we can do to improve the financial resilience for the region. So, as Sanjay already mentioned, things are happening fairly fast. You know, the inflation pressure has been building around the world and Asia. The Fed has been already raising the interest rate quite rapidly. The dollar reached historic highs in many Asian economies. And it could hurt even more if it feeds into the depreciation expectations. And often in the past, we witnessed during the periods of market volatility, unwinding of carry trades can exacerbate the currency depreciation in emerging and developing countries. So, well, I don't have to repeat a lot of things that were happening, but we saw that the inflation is trending upward already. This is already quite evident. Many ASEAN economies and Fed rate hikes have also led to currency depreciations and trigger portfolio outflows across ASEAN +3. So this is, again, a classic case of a trilemma. We again experience the difficulties of maintaining monetary independence, FX stability, and keeping open capital markets. So the structurally, you know, if you cannot really maintain these three, the impossible trinity, then what we are experiencing is, again, the FX instability in the region. What we saw in the region, FX depreciation has been negatively correlated with the interest rate differences. This is actually the direct violation of uncovered interest rate parity, but it is very consistent with empirical regularities. In the literature, you know, there's a idea behind this UIP, the uncovered interest rate parity. If the markets are perfect, efficient, and if investors are risk neutral, then there should be no opportunities for this arbitrage. And the UIP premium will instantly disappear. Of course, in practice, it doesn't really work. And the persistence of the UIP premium have led to a very active carry trades. Carry trade, as we all know, is a trading strategy to take advantage of the UIP deviations, the premiums, by borrowing in the lower yielding currencies to lend in the higher yielding currencies. And if the carry trade volume and activities are sufficient to enough to keep the UIP, then the arbitrage opportunities no longer valid, and then you know, we will actually see this uncovered interest rate parity always hold. We all know that it's maybe the dream world. In the reality, it didn't work. Many empirical studies have already proved and proved again that the UIP condition didn't work. And some of the literature pointed, yes, either of those two, the assumption doesn't work, right? Like the market's probably not efficient. Investors are probably not risk neutral. So FX speculation does exist through this form of the carry trade to take advantage of this premium. And the literature also argued that there's probably a required risk premium. And if, but if you think of like a reverse, then if the markets are more efficient, investors are allowed to maintain a bit more of a risk-neutral approach, then you will have less and less the URP premium. Why is the URP premium a problem? Like we saw that the depreciation, I mean, the interest rate changes and the depreciation may actually trigger even greater expectation of the depreciation, which causes the instability. So these relate to the structural weaknesses of the FX market. What we saw in the recent literature is that the UIP premium dynamics actually differ between the advanced and then the emerging market economies. In advanced economies, the UIP premium tend to be addressed by the FX adjustment, while in emerging market economies and in developing countries, the UIP premium tend to be much more driven by the interest rate differentials. So that kind of signals that there's a bit of, the issues, that the fundamental issues that the FX market are not really functioning sufficiently to ensure the smooth FX adjustment. Across the region, in the early period, I was so glad actually the BOJ governor, the Kuroda, mentioned about the importance of the local currency bond market. And it's been already 25 years ago. I actually didn't really calculate the years, but I heard from the Kuroda-san. There has been an active efforts to develop the local currency bond market, addressing the original sin. I think everybody heard of the original sin. We have seen the emerging market economy having difficulty in borrowing the local currency for long term. And in the early years, I think many policymakers in the region felt that the development of local currency bond market might have been a panacea, some sort of like solution to address this original sin. But we also saw that local currency denominated debt could trigger unwinding of carry trade by international investors if we do not have a structural issues addressed in the FX market. That meaning that there's not enough like a hedging tools to allow the investors, no matter like what the nationality will be, like the foreign and domestic, if they are not allowed to address and then effectively hedge their currency exposure, it will simply shift the risk of the currency mismatches from the emerging market borrowers to international investors, hoping that international investors are more sophisticated and have a better tool to hedge the currency risk. But in reality, it didn't really happen. So what we, in recent studies that are in the bank, we actually looked at the development of the local currency bond market. If it helps address some of these structural issues. But in fact, we realized that the LCI bond market does help improving the market efficiency, meaning that it reduces the UIP premium and the deviations. But it doesn't necessarily protect the market from the volatility driven by the international investors, given still the inefficiency of currency hedging and then the insufficient development of the money market that allows the smooth FX adjustment. So overall, I want to end by these key messages. Yes, there's a turn in the global financial cycle can hurt the emerging market borrowers. We still experience the structural weaknesses that do not really protect and then shield the emerging Asian economies from the spillovers and then the external shock to the global financial system. High and growing exposure to the dollar funding by the global non-US banks remains a source of structural financial volatility. We've noticed, we've witnessed actually in Asia, despite the increase in local currency bond markets. And then, in fact, now about 30% of external borrowing are in local currency. But what's interesting is the dollar-denominated debt is still more than 50%, while the euro-denominated external debt has declined. What does that mean? The Europeans no longer actually use euro. These are non-US banks who have to resort to the offshore dollar funding. And there's a greater even reliance of the non-US banks who do not have a direct access to the Fed liquidity facility. Will have to growingly rely on the offshore dollar funding. This is still the source of the structural vulnerabilities. And during this period of time, financial stress, the non-US global banks may be forced to curtail lending to the emerging market economies, especially Asian borrowers, if they do not have adequate tools or the effective ways of hedging their currency exposures. So the region's policymakers should still remain very vigilant against the financial turmoil. We need to strengthen regional financial safety nets and further develop the vibrant local currency bond market to address the original sin, but at the same time, nurture, develop the currency hedging tools, money markets, futures, forwards, the financial derivatives market, to strengthen the resilience. Thank you.
Thank you, Cyn-Young. Well, Cyn-Young has just given us a very good explanation of the transmission of shocks from the US interest rate to across the world. I guess we live in a US-dominated global financial system. And apparently, even though countries develop the local bond market, they're still subject to this global financial cycle. Our next speaker, Mr. Tao Chang, unfortunately is unable to join us physically, but he will join us virtually via video recording. Mr. Chang is a Chief Representative of BIS for Asia and Pacific in Hong Kong, and he was a former Deputy Managing Director at the IMF.
Dear colleagues, first of all, I would like to thank Co-Chain and colleagues from the AMRO for the kind invitation. I want to begin by congratulating AMRO for the inauguration of the forum. This is both timely and topical at a time when policymakers in the region continue to face uncertainty and trade-offs on both domestic and external fronts. On the domestic front, most regional economies are engaged in getting inflation back to target. In the process, growth is taking a hit. The negative impact of higher rates on slowdown in economic activity can already be seen. Moreover, while increased borrowing by government and the private sector in the last 3 years helped overcome the pandemic, it amounts to greater debt service burden now, especially in the face of rapidly rising interest rates in many regional economies. On the external front, global financial conditions have tightened. Most regional economies experienced volatile episodes of capital outflows alongside currency depreciation against the US dollar. This, combined with rising domestic interest rates, has led to a domestic tightening of financial conditions, as reflected in spiking long-term bond yield in most Asian economies. Moreover, in contrast to previous episodes, this time is unique in the sense that commodity prices increased rapidly at the same time when global financial conditions tightened. It is also expected that global growth will face strong headwinds in 2023, including some of the major economies from within the region, which is another source of challenges to the region's outlook. In the meantime, uncertainty remains around how geopolitical tensions would evolve and when they would resolve. A multi-dimensional challenge calls for a multi-pronged policy response. A macro financial stability framework, or MFSF, which is proposed by the BIS, offers a comprehensive framework to organize our thinking at this juncture. The overarching goal of the MFSF is to flatten the curve of both real and financial boom-bust cycles using a combination of various policies. To this end, the framework features the joint operations of monetary policies, including foreign exchange and bond and money market interventions, prudential policies, and fiscal policy. A key aspect of the framework is its emphasis on both ex-post and ex-ante policy measures. That is, a coordinated policy response, ex-post, and the building of resilience and buffers ex-ante. In other words, both preventive and mitigating measures are needed to meet the ultimate objectives. Economies in the region have made substantial progress in the last 2 decades toward strengthening their MFSFs, which is the lessons they have drawn from the Asian financial crisis 25 years ago. This has enabled them to orchestrate a robust response to the current challenging situation. Naturally, there are differences in the circumstances under which the economies entered the current challenges and the ex-ante buffers they had. That said, the MFSF remains a useful framework to build the understanding of the optimal mix of policies in various settings. For one, the main goal of monetary policies is to keep inflation under check. But what the regional experience this time underscores that a prompt and early response can make it easier to combat inflation down the road. It also suggests that past effort to anchor inflation expectations, say via implementing inflation targeting or improving communications, are paying off in the sense that inflation in the region has risen, but on average not broken historical records like elsewhere. Another crucial aspect of the MFSF is coordination across different policies. In the current juncture, fiscal policy would need to adopt a tighter stance to support monetary policies in controlling inflation. Targeted subsidies or transfers are justified to temporarily ease inflation pressures, especially for the poorest sections of our society. With monetary and fiscal policies largely focused on trade-offs between inflation and growth, complementary policies would have to take a more prominent role in dealing with financial stability concerns. For one, exposure to global liquidity shocks and dependence on commodity inputs would guide the need for foreign exchange interventions. At the same time, the depth and tightness of domestic financial market would inform the need for domestic money or bond market interventions. Finally, in some economies whose housing market starts to cool down, macroprudential measures could play a very useful role. To conclude, as financial stability risks increase amidst global economic uncertainty, Asia would need to be more attentive to these risks and continue to actively deploy a multi-pronged approach to navigate these challenges. The BIS, as a global institution, is tasked to support central banks' pursuit of monetary and financial stabilities. The BIS colleagues around the world and in the Asian office stand ready to work with colleagues at central banks and regional institutions like the AMRO to support their endeavors. Thank you.
Thank you, Mr. Chang. Well, we just heard from Mr. Chang the new macro financial stability framework that the BIS is developing or developed to deal with the multi-pronged challenges facing the region. I guess, in economics, we believe that you have one target, and since we have multiple shocks and multiple challenges, we need to basically think more creatively of a combination of different types of policies to deal with the challenges. Let me move on. We are coming back to our speaker here. Next speaker is Yiping Yi. Mr. Yi is a Deputy Secretary in the Ministry of Finance in Singapore, and he will be discussing Singapore's policy response to the challenges facing Singapore. Thank you.
Well, thank you, Hoi, and my fellow panelists. I think like economies here today, we face similar uncertainties. We face the same supply chain disruptions, heightened food and energy security risks. And like many economies, Singapore has also deployed both monetary and fiscal policy to dampen inflation and to address cost of living challenges. As a small and open economy, Singapore is susceptible to imported price pressures. And as such, I think we've worked as a government to make sure we manage import inflation. We've tightened our exchange rate-based monetary policies. In fact, MAS undertook a 5th round of tightening over 1 year. We do expect core inflation to stay elevated. I think similar observations earlier this morning for the next few quarters, and hopefully to taper down around the second half of next year as the tightness in the domestic labor market eases off, and hopefully global inflation too. I think that said, there are still upside risks to the inflation outlook, including from fresh shocks to commodity prices, as many have observed already today as well. Economy is expected to grow between 0.5% to 2.5% in 2023. Still watching this very, very carefully. On the fiscal front, Ministry of Finance has rolled out targeted support to cushion the impact of rising cost of living, including a series of support packages in the course of this year. We've tried very hard to find this balancing act to make sure we focus on individuals who are particularly vulnerable to lower income, those who might be disproportionately impacted by the economic situation. So some examples, we have provided a cost of living special payment, vouchers for spending at local shops and supermarkets to help with daily expenses, but also public transport vouchers targeted at the lower and the lower middle income to help moderate their transport costs. So we've calibrated our packages to be able to fully cover the increase in cost of living projected for lower income households, and also taken care, I think, partially cost of living for the middle income household as well. For businesses, we recognize that some might face a higher operating costs in the near term. We've increased government support in schemes, including for progressive wage credit, as well to support the wage increases for lower wage workers. We continue to have an eye on our longer-term economic restructuring so that we can nudge businesses to be more productive and energy efficient. So maybe just to share, we have an energy efficiency grant for local SMEs. This allows them to adopt energy efficient equipment and solutions. And this is the more correct and structural way that they can improve then their efficiency levels, reduce consumption, and reduce the cost of doing business. We're also making enhancements to enterprise financing scheme, which will support enterprises facing cash flow constraints. I think we continue to find this balance. Our policy design has been guided by a few principles. First is that fiscal support should avoid undoing the efforts of monetary policy and should avoid exacerbating inflationary pressures. So and that explains why we've been very, very targeted in our support. Second, we are quite clear that price signals should not be distorted because these are needed for economic restructuring and transformation. We are quite determined to press on with efforts to tackle climate change, to care for our aging population, and these structural moves will allow us to transition to a more sustainable, inclusive, and productive economy. We still have to advance our medium-term agenda and chart our way forward in a fiscally responsible and sustainable way. And I think the real uncertainty is how prolonged these challenges are. If I could also maybe just take a couple of minutes, I thought to also share thoughts on the opportunities then for AMRO as the preeminent macro surveillance unit for this region. I think AMRO has played a very useful role in timely surveillance products throughout the COVID pandemic, which has been very helpful to member authorities who are seeking to formulate appropriate policies to cushion the impact of the pandemic. There are probably a number of opportunities for AMRO to further enhance its role in prevention, preparedness, and response. I think in prevention, I think AMRO can continue to provide timely and practical suggestions to members on how to transition in a smooth and orderly way beyond the current policy tightening and prevent current issues, I think, from coagulating into a broader crisis. Second, for preparedness, I think beyond the immediate challenges, AMRO does have the opportunity to play a useful role in helping members prepare for subsequent financial crises. And this can come from developing in-depth knowledge of each economy to better support policy recommendations. I think this will then help rebuild our region's fiscal sustainability and strengthen our macroeconomic fundamentals. And third, I think for response, I think we need to continue to strengthen the global financial safety net with IMF at the center, and also ensure ASEAN plus 3 members can readily access resources from the GFSN to respond to future crises. So I think in that way, AMRO does have the opportunity to play a pivotal role in helping members. So I look forward to insightful exchange. Thank you.
Thank you, Yiping. So we just heard from Yiping about the very comprehensive stimulus package that the Singapore government enacted, to support the economy during the lockdown. And I think it was a very successful one because it's quite effective in supporting the economy and avoid the scarring. And you saw that in 2021 when the economy rebounded very strongly, and also the role that we can play in terms of supporting the region. Before we move on to Huazon, we have Dody, the Deputy Governor of Bank Indonesia, who can join us virtually through video recording. So let's welcome Pak Dody's presentation.
Distinguished speakers, ladies and gentlemen, first of all, let me extend my appreciation to AMRO, ADB, and ADB Institute for conducting today's important event. This forum will serve as a platform for fruitful and open exchange discussion during this challenging time for the global economy. On behalf of Bank Indonesia, I'm pleased to deliver short remarks providing perspectives on these timely and relevant topics. The global economy is prone to moderation, accompanied by high inflation and heightened financial market uncertainty. After some signs of recovery in early 2022, the global economy continues to face tremendous challenges from the ongoing war, broadening inflation, and the slowdown in some major economies. In 2023, the global economy is expected to decelerate further than previously expected, with the risk of recession in several countries. Growth projection has been revised down in several advanced economies, particularly in the United States, Europe, and China. The growth moderation, stemming mainly from the war and geopolitical tension, has triggered economic, trade, and investment fragmentation. The contagion effect of the fragmentation is also expected to undermine emerging market economies, including Indonesia. Meanwhile, global inflationary pressures, driven mainly by supply chain disruptions, have spurred more aggressive monetary policy tightening worldwide. A higher for longer FFR, Fed fund rate, strengthened the USD to a very high level, thus inducing pressures in almost every economy. Currency pressures are escalating, exacerbating portfolio outflows from emerging economies, including from us. However, the emerging markets economic resilience, including ASEAN, has stepped up. Sound economic fundamentals, resilient economic fundamentals, which are currently better than in the previous period of market turmoil, are expected to positively impact on efforts to mitigate further spillover from overlapping and more considerable global shock. Given the high uncertainty in the outlook, central banks around the world are facing a dilemma between maintaining stability and ensuring the ongoing recovery path. Considering the stability risks and stubborn inflationary pressure, a more aggressive monetary policy needs to be carried out. Although the objective of curbing the demand justifies this effort, the step was taken at the cost of slowing down the economic recovery process and at the risk of increasing the probability of a recession. In facing this dilemma, Bank Indonesia believes that there are three strategic aspects that need to be considered. First, amid the complexity of the recent challenges, Bank Indonesia continues to strengthen the policy mix to maintain stability and growth momentum. In this regard, the monetary policy should focus on efforts to maintain stability and bring inflation back to the target, while our four other instruments, namely macroprudential policy, payment system policy, financial market deepening policy, and green inclusive financial market economy policy, focus on supporting national economic recovery. Monetary policy is continuously strengthened through an increase in the policy rate, strengthening monetary operation, and bolstering the IDR, domestic exchange rate stabilization policy. Efforts to tackle inflation are also supported by solid policy coordination among key stakeholders in tackling supply-side related constraints by encouraging food supply availability, smooth distribution, and effective inter-region cooperation. The second point, in a high uncertainty environment, central bank policy communication becomes crucial in managing expectation. Central bank communication is a tool for holding accountability and can also be part of the monetary policy toolkits in ensuring inflation expectation is well anchored. Clear communication on the current economic condition, policies adopted, projection, and also policy direction will influence people's expectation and also people's behavior, forming the path of inflation expectation. Therefore, the whole communication strategy needs to be strengthened to enhance the effectiveness of the policy transmission through the expectation channel. In this regard, Bank Indonesia consistently maintains clear communication, especially by enhancing forward-looking content and also guidance to anchor expectation. Bank Indonesia also increases the frequency and continues to improve the reach and quality of communication material to the public. The critical message includes how Bank Indonesia stands ready to safeguard the economic recovery while navigating the mounting pressures from the global financial market volatility. The third point, strengthening the synergy and coordination of the central bank with the government and related authorities is a must. Given varying policy space between countries, even with the tendency for the less policy space in many countries during the pandemic, fiscal monetary coordination has become a key ingredient to bring inflation back to the central bank target, while providing necessary and targeted fiscal support for most vulnerable group of people. In this regard, maintaining positive perceptions from investors on the credibility of the policy response taken by the monetary and fiscal authorities is also a driving factor for maintaining overall stability, providing also additional resilience in the emerging market economies. In this era of a more interconnected world, extensive international cooperation with the regional counterpart is warranted to solidify economic resilience. To that end, Indonesia, as the upcoming 2023 Asian Chairman, is fully committed to enhancing regional economic cooperation to increase resilience and sustainability amid this challenging time. To conclude, I see the forum as one of the essential elements of this region's long-standing economic cooperation, providing space between policymakers and global experts to forge our common values and craft a shared solution for a brighter path to our economic recovery. I stop here. I thank you and have an insightful discussion.
That was Pak Dody. We have to thank him for that. Pak Dody, I mean, as we all know, Indonesia has taken a multi-pronged approach. You know, it reminds us of the what the BIS presentation. The BI has always taken a policy mix approach, similar to the integrated policy framework that the IMF has adopted. And they emphasize, in particular, the close relation between the BI and the Ministry of Finance, you know, in terms of addressing the challenges. Before I move on, I just want to remind our audience that to put in your question through the Slido, you can scan the QR code in front of you and put your question in there, and then I will ask the question. And if you want, you can address the question to whichever speaker that you like. Yeah. Okay, next I'd like to call on Jwahong, who is the Deputy Governor of the Bank of Korea, to make his presentation.
Okay. Let me first join my colleagues congratulating 25th anniversary of AMRO, and I'm very happy to be a part of this wonderful event. And today I will talk about the Korean experience mainly. Korea has many things in common with the other economies in the region in terms of economic and trade structure. But on the other hand, Korea is also one of the most open and most closely integrated with international financial markets. So I think Korean experience could be a good reference point as to what have happened and what could have happened during this episode of multiple external shocks. So my presentation today is composed of two parts. I'll first talk about the spillover effects of global supply shocks onto Korean economy and our monetary policy responses. And then I will move on to major financial stability concerns we have during this monetary tightening cycle. Okay, entering this year, the global supply disruption overall have been easing. However, due to the prolonging war, energy and food prices remain elevated, pushing up inflation. Most countries in the ASEAN Plus 3 region are net energy importers. The inflation had been relatively stable at the beginning compared to other regions. However, they are now witnessing higher inflation due to the higher energy and food prices. Since Korea relies heavily on imports for their 90% of energy and more than half of food, we have been hit hard by the rise in commodity prices. Continuing its upward trend after exceeding 4% in March, Korea's CPI inflation peaked at 6.3% in July. And this time, unlike in the past, international oil prices and the US dollar moved in the same direction. A weaker Korean won has put additional upward pressure on consumer price inflation via the import price pass-through channel. During this year, for example, the value of Korean won declined up to 21% as of September 28, the steepest depreciation in the region following the Japanese yen. As a result, despite the slowing upward trend of oil prices since August, energy import prices in local currency have continued to rise owing to the currency depreciation. So a series of unfavorable supply shocks has lasted longer than anticipated and is very much complicating our monetary policy. An increase in energy and food prices not only raises inflation and inflation expectation, but also holds down economic activities through reduced real purchasing power and weaker aggregate demand. If we raise interest rates sharply in response to these external cost shocks, monetary tightening could have a larger impact on the economy. In addition, with household and corporate leverage already at elevated levels, rapid policy rate hikes are likely to aggravate financial market stress. On the other hand, rising energy and food prices also put upward pressure on currency depreciation through a weaker trade balance. Under these circumstances, if rate hikes are not sufficient, currency depreciation could push inflation up further. In the face of this trickier than ever before balancing act for monetary policy, the Bank of Korea raised its policy rate by 50 BP each in both July and October, as it felt the need to accelerate its monetary tightening from its earlier stance of gradual normalization. In addition to the fast rising inflation and inflation expectations, pressure for currency depreciation driven by the front loading of the Fed's rate hikes and the increase in FX market volatility were other considerations in our decision, as they could be a source of financial strain, pushing up capital outflow pressure and causing herd behavior in the FX market. In November, we recalibrated the pace of rate hikes to 25 BP, given the recent slowdown in inflation and heightened financial market volatility, largely driven by tightening financial conditions. Going forward, the BOK will focus on price stability while calibrating monetary policy carefully to the evolution of economic activity and of FX and financial market conditions. Actually, this one. Now, let me turn to the key factors we watch closely alongside inflation and economic activity in determining our pace of tightening and the terminal rate. In this tightening cycle, which is unprecedentedly rapid and highly synchronized globally, one key policy challenge is how to maintain the stability of a financial system that is so accustomed to low interest rates. A strong US dollar driven by the accelerated tightening by the Fed has put considerable pressure on the $1 exchange rate. Of course, factors specific to Korea, including a diminishing current account surplus due to rising energy prices, has also played a role. However, as you can see in the graph in the left-hand side, the Korean won to US dollar exchange rate has generally followed the US dollar index, and that trend has only intensified this year. Therefore, basically, the recent rise in the exchange rate can be understood as a process of FX revaluation following the fast tightening. In particular, as the $1 exchange rate in October soared to its highest level only been seen during the past two crises. Against this backdrop, the Bank of Korea, together with the government, has carried out smoothing operation through FX market interventions, and also we took various measures to relieve the mismatch in the mismatch between demand and supply of foreign exchange in the foreign exchange markets. But what I want to emphasize is that the rising depreciation pressure has not been driven mainly by issues of economic fundamentals, such as a currency mismatch. So the strains in the FX market also remain relatively mild. As you can see in the right-hand side in the graph, and in the left-hand side graph, we can see that the exchange rate, the level is comparable to what we have seen during the past crisis. But strain in the FX funding market is very stable. But meanwhile, the recent sharp currency depreciation combined with domestic monetary tightening has spilled over into domestic financial markets. Long-term interest rates have risen and stock prices have fallen due to increased volatility in exchange rates, mounting pressures on capital outflow, reflecting expectation of further depreciation, etc. In addition, margin calls for FX derivatives positions and the additional cost of FX hedging have made financial institutions increase their bond issuance, leading to a worsening supply-demand imbalance in the bond market. For example, the steep rise in the exchange rate in September prompted large increase in margin requirement amounting to 9.3 trillion won for domestic banks' outstanding OTC derivative positions. Domestic banks had to issue their own bonds and to purchase government bonds to meet the LCR requirement. At the same time, the Korea Electric Power Corporation also expanded its bond issuance to secure operating funds in the face of mounting deficit under government price control. That led to wider credit spread and crowded out other corporate bonds. Now, in particular, we are more concerned what is happening in the CP markets. Amid growing concerns about cooling housing markets, a couple of accidental events triggered a temporary liquidity crunch in certain segments of the market with relatively large exposure to real estate sectors. For example, liquidity conditions temporarily deteriorated in Korea CP and PFABCP, which are major financing channels for project financing, and also for some NBFIs who have high exposures in these businesses. This crunch was triggered by a misguided decision by a provincial government, presumably for some political reason, to not honor its guarantee concerning debt issued by the developer of Legoland Korea, a theme park in that province. In response, Korean authorities initiated the CP and corporate bond purchase program and have also tried to adjust the bond supply of public corporations and financial institutions. These policy responses have helped prevent any market unrest in certain segments of the market from developing into a systemic crisis. In conclusion, despite the surging exchange rate, foreign currency liquidity conditions remain stable so far, and any liquidity crunch in some segments of the domestic financial market has also been manageable. However, global financial conditions are expected to keep tightening for some time. Thus, we will watch more carefully the evolution of financial markets as tensions could rise more frequently down the road through the interplay of exchange rate hikes and capital outflows, asset price adjustment, and increased credit risk. Let me stop here.
Thank you, Hua Zhong. The Deputy Governor has just given the challenges facing central bank in responding to the rising interest inflation, especially in the context of a country where you have maybe high household debt, corporate debt, and the spillover into the financial markets as well. Next, I'd like to call on the BSP Senior Assistant Governor, Iluminada, the Sicat, to make a presentation. Thank you.
Thank you, Khor, for inviting the BSP. Thank you to AMRO for inviting the BSP, and I would like to join the other speakers in congratulating AMRO for organizing this very timely event. I'll be presenting here, some of the views that we have regarding the recent macroeconomic and financial developments, and so far how the BSP responded to these challenges. Of course, the speakers have, being the last, the speakers have already identified and enumerated the new developments that are posing new challenges to policymakers. I will, in the next few slides, I'll be running down some of the major challenges that policymakers are facing. Well, inflation is expected to remain above target across jurisdictions due to the ongoing supply issues and sustained broadening of price pressures. Just like any other countries, the BSP is also struggling to, struggling with the higher inflation. And based on our expectation, our inflation outlook for the next 2 years, 2022, including 2022 and 2023, we will be still above the target range. However, because of the policy actions that we've already undertaken, we believe that inflation would revert back to the target inflation range by 2024. I present here some of the countries that market analysts believe would have a better performance in inflation and maintaining an inflation rate that is within the expected inflation target. And Philippines is one of the countries whose inflation rate will revert back only by 2024. There are other countries on the left side of the panel which would be more fortunate in bringing down their inflation and are within the inflation target. Well, the MD earlier mentioned that IMF has reduced its growth forecast in 2023. And based on a survey done by Bloomberg, we looked at how growth forecast would be for other countries, in 2023. Here, we present the forecast. The bar chart will present the growth forecast of the economies, and the green line would represent the 10-year average GDP growth. And looking at the chart here, except I think for Japan, which would be able to post GDP growth, within the 10-year average, the Philippines, for instance, would be recording a GDP which is a lot slower than what we had in the past. If you look at the Philippine data, we've been posting a 6% growth over the past 2 decades. But because of the pandemic, we will be posting a growth which is below the pre-pandemic level. Just like other economies as well, we were affected by the US Fed tightening, and this resulted to the depreciation of the currencies and volatilities, and in not only in the Philippines but in other regional currencies. The Philippines is shown here by the purple line. If you see, well, our currency is not as depreciated as the other currencies, but nonetheless, if you look at the trend of the peso over the last few months, we've been depreciating as a result of, Fed tightening. In this chart, we present some of the policy actions which the BSP has adopted in order to respond to the challenges. Well, the BSP has relied on the combination of monetary policy adjustments as well as interventions in the foreign exchange market. If you look at the chart on the left, it shows there that the Philippine policy rate has been increased by 300 basis points since May of this year. We've been very aggressive. As one of the speakers mentioned earlier, it would be best to take policy actions way ahead in order to tame inflation. And in addition to that, we also intervene in the foreign exchange market. We made use of our gross international reserves. Our GIR has declined considerably from 109 billion at the start of the year. Based on latest data, GIR, our level has declined to 94 billion. And we use part of that in order to address some of the excessive volatility in the peso as a result of the very aggressive adjustment in the monetary policy of the US. Although it was noted earlier by one of the speakers that the exchange rate pass-through has been reduced, what we noted, since we adopted inflation targeting, the pass-through of exchange rate to inflation has been reduced. However, if the depreciation is so large, the impact on inflation would also be large. So that is something that we are also mindful of. That's why we took a very aggressive adjustment in our policy rate. We are also aware that increase in policy rates would have an impact on economic growth moving forward. But it's very important that we tame inflation so that we can ensure the long-term sustainability of economic growth. What we looked at here is that we would like to make sure that inflation rate is well anchored. Looking at domestic liquidity, we see here on the left panel that the steady growth in our liquidity, which can support the requirement of the economy. Nonetheless, we are mindful that policy rate increases would have impact on the non-financial corporates. So here on the right panel, we tried to look at some of the financials of listed companies in the Philippine Stock Exchange, and we tried to look at them based on profitability, their conditions, profitability state, the liquidity status, and the leverage. So we tried to evaluate the impact of policy increases of some of the corporates. And what we found out here, before I move on the numbers, The redder the black is, that implies that the financial condition is becoming unfavorable. Now, on the profitability, what we found out is that as of second quarter of 2022, profitability for property sector, for the services sector, as well as the industrial sector, has been performing well. Although some of the sectors such as mining has been affected, the profitability of the mining sector, as well as holding firms, have been affected by increases in global prices of fuel products and raw materials. Now, in terms of liquidity or ability of the corporates to be able to pay off some of their liabilities, looking at their current ratio, what we see here is that current ratio remains to be 1%. Current receipts more than the current liability, and the ratio is 1% more. So that goes to show that corporates are able to pay off some of their current liabilities. We also look at the interest coverage ratio. The IMF threshold is at least, the ICR must be at least 2 times. And based on the indicators that we saw, all the sectors ICR are well above the 2 times threshold set by the IMF. So this means that they still have the capability to service their current liabilities. Now on borrowings, what we saw is that there were sudden increases in the borrowing of the corporates. This could be explained by the fact that because of the reopening of the economy, a lot of firms are now borrowing to fill up some of their capital requirements. It's not a problem for now. We think that it's not a problem for now. What will become troublesome if we see a persistent increase in borrowings of these corporates. In terms of strength of the banking system, we see that the banking system has remained stable and resilient. They have robust asset level, deposit, and lending, which could provide ammunition to fuel the financial requirements of the economy. So we believe that the banking system remains to be strong to provide the necessary liquidity requirements of the economy. And if you also look at the buffers of the banking system, they remain to be healthy, well above the threshold, minimum threshold set by the BSP, as well as threshold based on BIS standard. So we believe that the banking system can remain to be a basic important factor to move the economic recovery in the country. Of course, the BSP recognizes that digital platform would be able to improve the way we provide financial services and the way we enhance and expand the coverage of financial inclusion. And therefore, it's the target of the BSP to make sure that we are able to digitalize at least half of the retail payments and ensure that 70% of the population, at least the mature ones, to have, the Filipino adults, to have at least, bank accounts so that, we take advantage of the digital platform. So, in summary, the BSP has made use of a toolkit, a policy toolkit, which comprised of 3 things. One, monetary policy. So we did adjust our interest rate aggressively, increasing our policy rate by 300 basis points in a since May. During that time, we also took off-site adjustment of 75 basis points because of the very fast depreciation of the peso. And we also see that inflation expectation is becoming more disanchored, and therefore to address that, the monetary board decided to take that 75 policy rate increase. In addition to that, we also responded by making use of our accumulated reserves in order to provide liquidity in the in the foreign exchange market and address the excessive volatility of the peso. And lastly, since the inflation problem emanated from supply constraint, we believe that the fiscal action to provide more supply would be able to help in bringing down inflation in the Philippines. So I think I'll stop here now, and thank you.
Thank you, Iluminada. I think we have now heard from four very different experiences in terms of policy responses. Every country is different. Philippines is special in the sense that it didn't use any subsidy to keep prices down. Prices are very market determined, and it's very much reliant on interest rate to respond to the inflation. And they've been very aggressively trying to anchor inflation. As the senior assistant governor said, they expect inflation to come down more gradually, but they have also taken advantage of the COVID to develop the digitalization of the economy. So that's the opportunity side that I guess most of us have not focused on as much. So now we come to the end of the presentation. We're going to go into our panel discussion now. So before I do that, let me just remind the audience again that if you have any question, please input your question into the Slido using the QR code in front of you. So I'm going to kick off the discussion by asking the first question on monetary policy. We know that the many challenges, many shocks, but one of the obvious issue is this very aggressive tightening of monetary policy by the Fed, and the pressure on central bank in the region, to hike interest rate, especially after May. And the question is whether, some have questioned whether the regional central banks are behind the curve. Others said that, the regional central bank have responded, maybe the timing was off because the recovery is still nascent, and they need to support the recovery more before they start tightening. So they resorted to other measures to keep inflation down before they start hiking rate. So the issue is, should the region's policymakers have responded differently, using maybe a different mix of policy instrument, as what we heard from some of the other speakers, including maybe CFM, which I think maybe one central bank may have used that. So I'd like to address that to Sanjay, given the France integrated policy framework.
Thank you very much, Hoi. There are a number of questions wrapped in your thing, and so let me try to address them a little bit by bit. One is on the question of whether the central banks in the region were behind the curve or not. I think, there are a couple of things one needs to keep in mind. One is that inflation started later in Asia than elsewhere. So when you compare to the rest of the world, it is kind of natural that Asia would start behind. But second also is there's been quite a lot of heterogeneity within Asia. The Bangko Sentral was one of the very aggressive movers, and it moved pretty quickly. On the other hand, the situation is also different. In Thailand, for example, they haven't raised interest rates as much because the inflation hasn't been as much as well. So countries within the region also, I think one needs to take into account the heterogeneity there. The second set of questions is on what set of different policy tools could have been used, and you mentioned the three-letter word CFM. My immediate answer to that would be to say, look, we're nowhere near there. I think, look, CFMs can be a useful tool in the toolkit, but I think it does come with this very large warning saying, handle with great care. And I don't think we're in a situation anywhere close to that, because we've seen financial markets function quite smoothly. The financial sector risks, after all the great stuff that the Asian central banks have done, Asian regulatory authorities have done over the last decade or so, are quite sound. We've seen some of that in the individual cases that we've presented today. The foreign exchange markets is acting quite smoothly. So we really don't see a case for that at all at this current point. It is fundamentally an issue of fundamentals. There's a difference in the pace of monetary tightening between the US and here, and monetary policy has to be the first line of defense. And I think, interest rate hikes have been the most appropriate response tool. There's been some talk of intervention. I think, intervention to smooth volatility is something that's cited a lot. But if that's the case, intervention should occur on both sides. If you're intervening to volatility, if it's only intervening to volatility on one side, that's not intervening to volatility. It's trying to fight against the pressures, and that's probably something that's not worthwhile and not be very effective in the long term. So I hope I took some of those.
Any of you want to add on to that or comment on that? Okay. Well, maybe I just express a view, which is that, I guess our view as, advice to a policymaker when the Fed started hiking its rate is that, we were really concerned that an aggressive hiking of the rate would actually derail the recovery in the region, especially since last year was a really bad year. They were derailed by the Delta outbreak, right? So we are coming from a low base, and that's one reason why inflation was relatively low, right? So we really didn't see the need for, and inflation also was quite low at that point in time. And because it's a supply shock, we felt that the response by the policymakers in the region in terms of capping the price increase by providing subsidy, as in the case of Indonesia, Malaysia, and Thailand, was quite appropriate, because that provides a space for the central bank to keep monetary policy low while the economy is recovering. But once the recovery is become more entrenched, then our advice was that the central bank should start the hiking rates, and we see that in the region, especially Indonesia. They have even lifted the subsidy on oil prices and all that. So I guess it's a judgment call, which is the challenge of policymakers face, right? The trade-off between growth and inflation, and the fact that if you hike rates too aggressively, there are also spillover effects on other parts of the market. Okay, let me move on to the next question, which is on Fed tightening. Are you want to add on to that? Yeah, please.
Let me just add one point. One of the difficulties Korean the government and the central bank had during this episode of fast depreciation was that, as Sanjay said, monetary policy would be the first line of defense. But before that, under this flexible exchange rate system, exchange market would be the first one to observe the shocks, right? But because of our experience of two crises before, Asian crisis and GFC, the exchange rate depreciation, especially the fast depreciation, is being perceived by the public as a signal or prognosis of a crisis coming. And it was really difficult for us to explain to the public that just exchange rate depreciation by itself is not that much a problem, because we know that Korea is a net creditor. We have plus FX position, almost all the economic agents. So, but just letting the foreign exchange market to observe the shock is very difficult in the case of Korea to do, just because of this difference in inflation pressure coming mostly in Korea. They are from supply side, unlike in the US. So we need to move in our own pace, but because of the pressure on exchange rate, it was very hard actually to execute that.
Yeah. Iluminada, please.
I'd also like to add something, just to correct the impression that the Philippines did not provide subsidy. Actually, we provided subsidy, but then because of the limited fiscal space, and a lot of spending was made to address, problem on COVID. So there were subsidies, but it is more direct intervention, more for sectors who were vulnerable to the price increases. So some subsidies were given to that population, and also we had a subsidy to the transport sector, in the hope that we are able to moderate the price increases as a result of increase in energy prices. And the government also lowered the tariff rates in order to induce more supply, particularly of agricultural products to come in, because agricultural product figure a big chunk in our CPI basket. That's why it's very important that we address the supply side. We know very well that monetary policy cannot address supply problem. But once inflation expectation come in, once there are broadening price pressures as a result of elevated inflation, then there must be something to be done by monetary policy. And in that respect, that's when we acted very fast.
Yeah, thank you for that. I should correct myself. When I say no subsidy, I don't mean that you don't provide any subsidy, but you don't have price cap on fuel prices or food prices, which is why your inflation is a lot more responsive to imported prices, I guess. But yeah, thanks for that. My next question is on, again, the Fed tightening. There's been a lot of concern, I guess, out there that when the Fed embark on this aggressive tightening, usually it triggers a financial crisis. This time around, it has not happened yet, but it's not over yet, right? We know that it's high for long. So I want to get your views about whether you think maybe there could be what's the risk, or rather, of a financial crisis? Cyn-Young?
Thank you, Howie. Well, there's always a risk of the spillovers from Fed tightening that has been witnessed during the past episodes of monetary tightening by the U.S. Fed. But I think people are fairly well aware of these risks. So I don't want to go over okay, what are the risks? Of course, there's FX instability, there's a capital flow reversal. But again, the important is, in the meantime, trying to maintain the macro financial and then a prudential policy framework. I think for economies that are at the greater risk are always the one that experience a weaker fiscal and external positions. Luckily, across the across the region, overall external fiscal positions have been relatively stronger. We learned the lesson the hard way, but in a very strong manner. Still, the issues that over the past now decades, and then in fact more than 2 decades, we've had such an extended period of global liquidity. And over those longer and again more artificially extended by the US Fed, who has been at the origin of this problem, we now have almost entrenched expectation of really persistent liquidity. And that has led many economies, both private and the public sector, to increase the debt level. For me, the real issue, the structural issue that the policymakers have to address is really the debt problem. From both public side, the fiscal prudence has to be restored. It will be very challenging for many developing economies to really sharply reduce the spending at this stage, given that the recovery is at the fragile stage. But over the longer term, there has to be a plan and a clear communication with the public that we are going to move into the consolidation phase after a certain period. And in the meantime, the debt that has been issued have to be reviewed. You can always structure the debt in a way to improve that resilience. Change the profile of the debt. Move things from external sources to internal sources, shorter-term sources to the longer-term sources. We have to address the fundamentals. Another important part is whether it is the private, like the households or the corporate sector, the debt issues have to be looked at more holistically. In the past, just even not even going for like a decade, we look at 5-6 period, and then the debt level has increased substantially. And then both the private sector, the household and then corporate sector have to make a conscious effort to reduce the debt to a more sustainable level. So as long as we address the fundamental issues, I think we should be able to use the macro financial and then prudential framework to ride out the storm. Thank you.
Thank you. Anybody else wants to chip in? Okay. Otherwise, I'm going to move on to a fiscal policy question. We all know that, the last few years there have been a lot of borrowing, fiscal deficit very large, and central banks are in the process of consolidating the fiscal position. In particular, in the case of Singapore, we saw a very sharp reduction in the fiscal deficit. But this is happening in an environment where you have a lot of headwinds going forward. Exports have slowed down. You have high inflation and high cost of living, and the government is concerned about supporting the vulnerable groups. So how do you address that issue of trying to consolidate the fiscal at the same time supporting the economy?
Yeah, thanks, Hoi. It's indeed a big challenge, and even in the course of this year, we've had to do very extensive engagement with the public and so on as we review our revenue sources. So we recently implemented the increase in goods and services tax on a schedule coming 23 and 24. But indeed, it's a challenge to just ensure we can achieve that appropriate policy mix. I shared earlier that the medium-term agenda really needs to be front and center. So we have aging population, we need to provide for their healthcare, which is why some of the revenue measures need to come in, but need to be communicated ahead of time so people can prepare. But for us, besides social skills retraining, making sure we increase the odds that businesses can become more productive, all those very important things, I think, perhaps got a bit postponed during the pandemic, and it's time to come back to those and push ahead. So for us, I don't think there's one solution, and we really need a whole combination of both expenditure but also revenue reviews in order for us to push ahead. Yeah. It is a challenge. Yeah.
Okay, I'm going to take a question from the floor. The question is, given that the majority of stimulus packages are going to expire soon, we basically encouraging authorities to withdraw the stimulus once the economy is recovering. And with inflation still rising, should the government extend or provide additional stimulus? What are the options? And how would the government manage the impact on the national debt? So I guess that the issue is, should, I guess, similar to the question earlier, which is that on the one hand, the stimulus policy have been withdrawn, but at the same time, we have a problem with higher inflation, high cost of living, and the need to support the economy. next year with the slowdown. So how should policymakers address this problem? Any of you want to take that? Yeah.
If I can just begin, I'm a little surprised with the question in the sense that I think, look, Asia is very different, so I don't want to say, there are particular lessons from the UK, but I think it's very important to keep in mind that the current, markets are very sensitive to policy incoherence. I mean, policies have to be coherent, right? If you're trying to reduce inflation on the one hand, and at the same time you're undertaking monetary tightening, but you're expanding on the fiscal on the other side, you're basically moving, it's two trains colliding, and that really doesn't make sense. And markets are quick to catch on to that, as we saw in the UK. Yes, there are some countries, I think, in the region who have larger output gaps than others. Others were closer, so I don't want to make a generalization. But at the same time, I think this is not the time for places. If anything, fiscal policy needs to support monetary policy in combating inflation.
Well, I think the policy really goal has to be clearly anchor the expectation. Again, that's correct. Like countries are all different, and then they are in a different position. So it's not easy to just say like, okay, in all countries, Asia, you have to do this. But in all countries, the one that probably come across is make sure that your policy is consistent and clearly communicated. Like this is our direct goal, and anchor the expectation. Whether it's going to be a depreciation expectation or inflation expectation, if you clearly communicate with the market, even for the debt sustainability, if we see the need for the fiscal consolidation, but how far is that ahead, and then what is the the medium term sort of a path to achieve that goal. If those are clearly communicated, at least the unnecessary stress from the market, coming from the uncertainty, hard to expect, those will be eliminated. And in that is going to be already a fairly good amount of, the stability.
Yeah. Yeah.
Just a follow-up to what Cyn-Young was saying. In the Philippines, we have what we call the Development Budget Coordinating Committee. And in that committee, the members are the Bangko Sentral as a resource. Of course, we do not participate in fiscal policy setting, but we are there to provide what are the views, external environment would be. So we help. And in the process, we also provide certain advices on how to coordinate monetary as well as fiscal. And in that forum, we are able to discuss well how the government would be able to achieve fiscal consolidation. And after the meeting, by the way, it's also, the membership also include the planning agency, just to make sure that everyone moves in the same direction, and all the other economic agencies are involved there as well. So in that committee, we are able to, discuss and coordinate what are the things that should be done. And immediately after the meeting, there is a press conference, and they present the plan on how to achieve fiscal consolidation and what would be the target on inflation, stuff like that. So this is something that, helped us in order to provide guidance, to the market, and it served us well. Thank you.
Yeah. I guess the question is how soon you consolidate, huh? And and whether depending on what's happening. I guess we need to look at the environment. If indeed the economy is going to be weakening next year, I guess it'll be very hard to argue against providing some support to the economy, and maybe delaying the consolidation somewhat. The question is maybe clear communication with the market may help you to at least not jinx the market. Okay, there's a question here about what is the best practice on anchoring wage expectation, and whether Asian government here should focus on improving labor productivity instead of worrying about inflation. Any view on that? I guess inflation has not, I mean, wage increases has not been an issue in the region, so as far as I can see. Maybe in the case of Korea, they were a bit aggressive a few years back, but this time around, I don't get a sense that, you know, the wage increases has been an issue.
We are seeing some increase in the wage, but not at the level of wage price spiral. So, you know, the economic agents, they are doing their own share. So, you know, until now, so I think wage growth is not the utmost concern for us at the moment.
What about Singapore? You can comment on that?
Yeah, our current focus is on the lowest income. We want to make sure that there's progressive wage improvements.
Okay.
I think then for the broader labor force, it would tend to be the sort of productivity, training, retraining kind of discussions. But it is a very tight labor market for Singapore right now. But we want to look beyond the short term to figure out then what are the true changes that need to take place, and talking to unions and employers in a longer conversation.
Yeah. There's also a question about exchange rate regime, whether cooperation increases, we will see a movement towards greater similarity of exchange rate processes. I think this has been a long-standing issue, whether at some point in time the ASEAN plus 3 region will come together to you know, develop some kind of coordination on exchange rate. Any of you have views on that? Or should we just let the market do the coordination? No, my view has always been that, you know, I mean, there's been a market process in terms of bringing you know, exchange rate together, and we saw that in the charts very closely, you know, where all the exchange rate tend to move together as a pack. But to fix the rate to one another, I think it introduced a rigidity in terms of policy making, because the economies here are very different and they are hit by different types of shocks. So you want to have the flexibility to, you know, for individual economy to respond to the shocks. And I think one good example is, for instance, the UK, when it, you know, decided not to adopt the euro as its currency. I think it gives the UK a lot of flexibility in terms of managing its macro, you know, business cycle.
I couldn't agree with you more on that. I think, you know, within ASEAN, we have commodity exporters and we have commodity importers, and they're facing completely different shocks, as you mentioned. And I think also, you know, the lessons that we certainly learned from the euro crisis, euro area crisis, just the differences between the South and the North in terms of the necessary policy packages that needed to be put together, a common fiscal union, a common banking union. You need, you know, even after many, many years of moving in that direction, they fell short. And I think we're still a long way from that in the region, at least.
Yeah.
Structurally, I do feel that, you know, there's a lot of issues to address to improve that affects flexibility. I mean, some of the discussion actually relate to my presentation. There are in exchange rate regime, there are great progress in terms of improving the FX flexibility across the region. Mm-hmm. But structurally, in terms of how the markets support that flexibility, still remain underdeveloped. That's why the many developing emerging market economies still face the challenges, you know, when there's a really drastic sort of capital flow movement or FX volatility, that the risks are often very disproportionately fallen large on emerging market economies. A lot of, if you think about it, like the advanced economies, the investors are more sophisticated, they have a better tool to hedge the currency risks. But then in reality, the market in emerging market economies, like the money market or like FX derivatives and hedging, that can facilitate those hedging activities either by the foreign investors, or like domestic investors, remain limited, which is aggravating, and then it actually accentuates the volatility. So the currency needs to overshoot to compensate those risks of adjustment coming after. So that's where I do feel that the Asian policymakers have to come together. We need to go extra mile to close that final gap. We have made a strong investment and then progress in terms of creating the financial safety net, creating the local currency bond market. There are greater now share of local currencies denominated in terms of the region's debt profile. Nevertheless, we still face a huge volatility coming from like the small portion of the foreign investors coming in. And I believe that this is where we, as a region together, promote even greater effort in building the market institutions and then infrastructure in the FX market.
Yeah. Well, thank you for that, because I think EMAP is working very hard in addressing some of these issues, as Governor Kuroda was mentioning earlier. Okay, we move on to the next question. We are running a little bit out of time. The next question is, how do we ensure that fiscal support for businesses are directed only at those businesses that are viable, and that we are not keeping zombie companies alive? I guess that's a challenge to a lot of authorities that are supporting small businesses and their forbearance policy, to allow for rollover of the debt. Any of you want to? No?
I think.
Well, I guess I think this is a real problem, and authorities are fully mindful of that. But so far, our view is that when we look at the numbers in terms of NPL and all that, we just don't see. I mean, it could be a risk in some instances. Sometimes you have to err on the side of supporting too many rather than supporting too few, because especially in the first instance when the pandemic hit. But now we're getting to the point where you need to fine-tune who are the survivors and who are not going to survive. And that's a very difficult judgment call, I guess. The next question is about regional cooperation. I'm going to leave that to the next panel. What should be the modus operandi in establishing a common financial currency and ensure macroeconomic stability in the long run? I think we addressed a bit of that just now. What does Asia need to do to survive the growing risk of economic fragmentation? Again, I think we can address in the next session. Should our expectation of healthy inflation level be changed to 3% instead of 2%? I guess this is the big debate now in the West, whether the Fed should maybe lower the hurdle by raising the inflation target to 3%. Maybe, do you have a view on that?
No, that's a very, very reasonable question. But at the moment, central banks, they are very reluctant to raise that issue, because it may undermine their credibility.
Yeah.
So not the very good time, the good moment to raise that issue, but ultimately we will have to deal with that, I think.
Yeah. No, we just came back from consultation with Japan. In Japan, of course, they set the hurdle at 2%, but inflation has been hovering at 1%, and the question is whether they should lower the hurdle.
That's a very, very easiest way to do our job. I mean, moving the target, but
Yeah, and I guess this may become an issue for the Philippines. I hope not, but
We are at 3%, one plus or minus 1%.
Right.
So we're at 3%.
so you have the flexibility.
Yes,
still.
we have.
Yeah. Okay. Okay. This issue I think you already addressed about interest rate differential or market intervention, which is better in terms of stabilizing the exchange rate. So this was addressed to Cyn-Young. You want to say a few words on that? Whether it's better to raise interest rate or use exchange rate intervention to...
Well, exchange rate flexibility will allow more of monetary independence, and then that's why it's important to actually improve the whole FX market institutions and then infrastructure to allow that flexibility in practice. So, interest rate. The differential, again, if you're not really looking at just from international sort of monetary perspective, interest rate has to be really aligned with inflation targets. Monetary policy has to be targeted to address the domestic inflation and also, in a way, the imbalance with the domestic growth. So that having somehow those two issues intertwined is more like a structural issue I think we should address. Thank you.
Thank you. I think we are almost out of time. So I'm not going to summarize the discussion. I hope you all enjoyed the discussion. It was a very interesting debate on some of the issues. But I think there are some key takeaways that I just want to mention, which is that I think we all agree that the region has been hit by multiple shocks. A lot of challenges ahead, but our sense is that the region has managed these shocks and the challenges relatively well until now. But unfortunately, we cannot declare victory yet because there are more shocks, more headwinds, more challenges ahead, and it's going to be even more challenging next year, I think, for policymakers in the region in addressing those challenges. Let me stop here. But the next session will talk about regional cooperation and how the region can come together to help address some of these challenges. Thank you.
Thank you very much.